Joining us now is our former Fed Vice Chair, Alan Blinder. Alan, good to have you. Tariffs going to be what one would imagine an important sort of focus, certainly in the press conference. Where do you stand in terms of the inflationary impact of tariffs, which we have yet to really see in any significance? Is it still coming?
I think it's still coming. I stand exactly where you are, that we haven't seen much from the tariffs yet. The tariffs have been announced, unannounced, announced, unannounced. I think at this point, nobody, certainly including me, knows where they're going to wind up. I'm talking about tariffs against our major trading partners, China, Canada, the EU. But, you know, Trump made a mistake confusing the UK with the EU, but the EU is the big, quote, country. It's not a country. But I think the markets are actually paying too little attention, not that they know what's going to happen, and neither do I, to the oil situation.
Why?
I mean, who in the world knows what's going to happen with the current strife in the Middle East? Happen to the price of oil? I mean, happen in general, we don't know. But in particular, in the narrow economic sphere, what's going to happen to the price of oil? It could be a big nothing, or it could be a very big deal. And that's a huge uncertainty, rivaling the uncertainty over tariffs, maybe even larger.
Yeah, although our viewers are looking at a chart right now, I mean, it shows that oil still was higher than this only, not that many months ago, Alan. I mean, we have dealt with far higher oil prices without having that large an impact on the economy, it would seem. Yeah, no, it's the speed of increase. We can deal with much higher oil prices in time, but if they shoot up because, suppose they close the Straits of Hormuz and oil shoots up over $100 a barrel in a very short period of time, that's a shock to all the industrial economies. Hopefully it won't happen. But as we sit here today, who knows what's going to happen over there?
How tight is the Fed policy where it is right now?
I wouldn't call it very tight. I just saw the president on your network say Powell is so stupid he should cut interest rates 200 basis points.
250, yeah.
That suggests it's very, very tight. It's not very tight. Look, we're looking at a 2.5% inflation rate against a 4+ short-term interest rate. That's not a huge real interest rate. It's a little high, a little tight. That's where the Fed wants it, just a little bit tight. And as Powell has said ad infinitum, given the behavior of the economy, it is not sinking like a stone. It may not be sinking at all. The Fed can afford to watch and wait to see how these tariff and oil uncertainties develop.
But isn't there more evidence of the economy softening than inflation flaring?
Yeah, I don't see any evidence of inflation flaring. You have to look forward to what the tariff increases as they phase in will do to prices. We've seen very little of that up to now. And as I just mentioned, you have to worry a little bit about oil. Maybe I just said a little bit. The market's worrying a little bit. I think I would be worrying a little bit more than that about the price of oil. Hopefully it'll be okay, but we don't know.
Finally, Alan, I wonder how much you're watching housing in particular this week. That NAHB number, third lowest since 2012. Residential construction spending's negative year on year. We always say housing punches above its weight when it comes to GDP, but is that worth considering more?
Sure. I mean, look, that's one of the sectors the Fed, I remember this from my time at the Fed. This is nothing new. That's one of the sectors the Fed watches most closely. If you're working on interest rates, you're thinking about the interest-sensitive sectors, and those are mostly housing and automobiles. So absolutely. But don't forget, as your question suggested, housing is ballpark 4% of the total economy. New. Spending on new housing is what I mean. Is something like 4% of GDP. Maybe it's, I haven't looked lately to know the decimal place. But it's not like the consumer, which is closer to 70% of GDP.
Alan, thank you, as always.
Pleasure.
Alan Blinder.